When it comes to the cyclicality of returns, like we discussed in our first video, we approach it very much like we approach market volatility. Rather than something to be feared or avoided, it's something that creates opportunities, and we should try and use it to our advantage. Our goal in this video is to demonstrate how we go about doing that. We'll start by going back to our comparison of growth versus value. Now, however, we're looking just at our proprietary valuation score. How we calculate this measure isn't the focus today, but at a high level, we use 4 fundamental valuation ratios and combine them based on their historical ability to forecast returns. The y-axis on the left-hand side of this chart has numbers above and below 0, and our valuation signal is called a z-score. At the risk of giving everyone painful flashbacks to high school, let's spend a second on how to understand what those scores mean. Hopefully this bell curve is vaguely familiar. The concept here is that if we were to look at a set of data, for example, maybe something like the height of US adult males, there would be an average and some variance around that average. Most men would likely be within an inch or 2 of the average, and if we were to plot every individual's height, more than 2/3 would be expected to land somewhere in the mint green shaded area. Those individuals would be considered of normal height, even if they were slightly shorter or taller than the average. Statistically speaking, those people would be considered having fallen within plus or minus 1 standard deviation, or what we're calling 1 z-score. Every individual that falls into the dark or light blue areas would be considered outliers and are of a height that is far enough away from average to be considered abnormally short or abnormally tall. We use the same concept when we look at the valuations between 2 investments, and our focus is on those outliers. Most of the time the comparison is normal or falls in the mint green shaded area, but occasionally it falls into the blue. And that's when we start to care. That's when we make adjustments to our portfolio. So with that in mind, let's go back to our earlier graph. We've now added in that mint green area to show that range for normal or fair. As this graph is laid out, anytime the valuation line is above the mint green shaded area, it indicates value stocks are abnormally attractive. Anything below the shaded area indicates growth stocks are more attractive. As expected, most observations fall within the shaded area, but there are a few that don't, and those are the ones that we care about. For brevity purposes, we're going to skip past the tech bubble today and just focus on the 2 more recent outliers. The first of those was in late 2008. The bursting of the tech bubble in 2001 led to a prolonged period of underperformance for growth stocks. Eventually, though, the valuation pendulum simply swung too far and reached a point where they'd become an outlier to the other extreme. This is an oversimplification, but using our methodology and our approach, this is the point that an investor should be shifting into more large-cap growth stocks, and then waiting patiently for valuations to normalize or go back to average. Something in this case took nearly 10 years. That's obviously a long time, but as you can see, the payoff would have been substantial. To be fair, in hindsight, we know that growth stocks continued to outperform for another couple of years. But once valuations return to a more normal level, the probability of success drops, and the risk of being wrong is higher. We know we'll never get the timing perfect. Nobody ever does. In fact, value investors generally know they'll be early, both on the buy and the sell side of an investment, and we're okay with that, as long as it means our rate of success stays high. Actually, my last example is one in which the valuation signal was early by close to 2 years. Tech and growth stocks drove much of the market recovery off the pandemic-driven sell-off in March 2020, and that led to their valuations reaching levels outside of that normal range. As we show here, outliers won't always revert quickly, and they didn't in this case. Growth stock valuations stayed as outliers or expensive for nearly 2 years before an investor would have been rewarded for shifting more towards value stocks. Needless to say, patience and conviction are important traits for any value-focused investor. I know this has been longer and maybe a bit more in the weeds than usual, but I hope you found it interesting and helpful as it relates to our philosophy and process. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video.